So have you recovered from the confusion 11 days ago when we were shocked, and of course certainly the gold industry was shocked, of that unexpected Trump administration ruling that certain gold bars would be tariffed?
It was a crazy day for sure, but it's actually why we built our business. So on one hand, a lot of our clients were kind of scrambling because this is now the third time in 5 years that the EFP, basically this price between LBMA and London, and the COMEX price blew out, and that caused a lot of risk for people. But we built Abaxx to launch a kilobar contract in Singapore, very specifically because that's where the physical market lives, and so that's. It was actually probably good news for us, but certainly our clients were scrambling.
There was a lot of scrambling, certainly. And you talk a little bit about trying to bridge the gap between how gold is quoted and priced depending on what geography you're in. What is the appetite for something that kind of unifies across the different geographies?
Well, we're already seeing very good open interest in trading on our exchange. It only launched about 6 weeks ago for our gold contract. And we're really having a lot of Singapore and really all Southeast Asia rallying around our contract because it is the product that they're demanding, right? Because again, a lot of like if you're buying gold over LBMA, that's really balance sheet gold. It's almost like foreign exchange markets. You're buying bilaterally with a bank. You're buying balance sheet gold. COMEX, of course, is physical, but it is kind of an older warehouse warrant system of older, 100-ounce bars mostly. But the main physical demand in the world is Asia for kilo bars. So, and that's what our market is kilo bars.
I am curious as to kind of where you think this market can go. We talk about gold right now, something like 33,000 an ounce, 3,300 an ounce, excuse me, in the spot market. You've seen forecasts, including today, UBS upping their price target to 3,600. We're already at record levels, more or less, and some of that certainly had to do with this administration and some of the policies coming in. If we start to get in leveling off of what's been happening in Washington, does that actually hurt the price of gold?
Well, again, I think physical demand has been very strong in Asia. There's a number of factors for that, but I think a lot of that even predates, some of the call it the volatility, policy volatility. Yeah. So I think, really we've been on a couple of years now, and it's really broken what used to be the old. When I was at Goldman, we always analyzed real interest rates as really the only factor, but now there's just a whole nother geopolitical bid from central banks that I think the market's still, even in 2 years on, trying to get comfortable with what are the metrics to analyze that.
I am curious, though, about where exactly the demand is coming. There's been a lot of speculation, whether it's coming from governments, whether it's coming from traditional investors, whether it's coming from organized crime. There's been a lot of discussion about where those demand flows. Do you have any sort of clarity into where it's coming from?
Well, I think that's one of the other issues is it's not going through the typical, or not all of the flows is going through the typical way, again, buying from bullion banks in London, right? So even when the first movement started happening a couple of years ago, a lot of it was going through Dubai, a lot of it was going through Singapore, and not your traditional gold centers. And again, it's much more demand for physical rather than just having balance sheet gold, with a bank counterparty, for instance.
How has demand for gold in its different forms, whether it's physical gold or balance sheet gold, changed with the rise in demand for crypto?
I don't see it totally correlated. I mean, of course, after some of the political, policy changes around U.S. dollars, after Russia's invasion of the Ukraine, of course, that changed a lot of dynamics that probably affected both crypto and gold. But I really see them as very different markets. In fact, we still see crypto as very, correlated to, tech stocks and so forth, where gold really is, a physical safe haven that people look for.
There's been a lot of talk about more tokenization of assets. I mean, we talk about crypto and obviously the digital universe, but it's more than just sort of holding, whatever the digital currency is. There's this idea that the underlying technology can offer a way to sort of make all markets more efficient. How are you sort of diving into that, if at all, beyond just the commodities trade?
No, it's actually probably this. Yeah. There's two pillars of our company. It's why I started the business. One is to get commodity markets closer to physical, but second, to move collateral markets in real time. So my former colleague at Goldman Sachs, Allison Nathan, just put out a great report on stablecoins, like literally today. And there's a lot of talk about stablecoins for retail payments, retail holdings in emerging markets. But a far orders of magnitude larger use case is collateral. moving US dollars in Asia or gold as collateral in Asia. And that's what you need for margins on, say, a futures trade. The Futures Industry Association actually just put out a great report about trying to move collateral to real time. And we really think we are going to be the first regulated clearinghouse in the world that will be able to do that with 2 upcoming pilots we're doing this year, moving tokenized money market funds in real time and moving gold in real time for collateral in Asia.